Howdy, everybody. Welcome, Liberty Call. Today is Friday, July 12th, 2024. Hope you're having a fantastical day out there. Apologize for being a little late. Had to go pick up mail at the office. Traffic sucked. Boy, it's hot in town. Whew. It was on 100 degrees on my little temperature gauge on my wife's car when I was in the city. It was quite warm. So thank goodness this will pass in a couple of days, and we'll be back to normal summer weather here in the mountains. So anyways, hope you're having a great day. It is a beautiful day here, other than the fact that it's the edge of the sun. But it is sunny and clear, which, that is nice. If it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, follow, and press that notification bell. All right, let's get into today's markets. Looks like the Dow pulled back a little bit from its peak. Was up 0.62%, 247 points, closed at 40,000 even. Well, there's some change after the decimal point, but right at 40. S&P 500 was up 0.55%, 30 points, closed at 56.15. NASDAQ up 0.62%, 113 points, closed at 18,396. The VIX was down 3.56% today. It's at 1246 right now. Canada up 0.57, Brazil up 0.45, and Mexico up 0.97. Headed over to Europe, Germany was up 1.27%, the UK up 0.36%, France up 1.27%, Netherlands up 0.95%, Spain up 0.72%, Italy up 0.76%, Switzerland up 0.95%, and Portugal up 0.14%. Russian exchange is back in the red today. The MOEX down 0.56%, the RTSI down 0.28%. And the Asian markets, the Nikkei was down, 2.46% last night. Australia up 0.88%. New Zealand up 0.14%. In China, the Shanghai was flat, up 0.03%. Shenzhen Component down 0.18%. China A50 up 0.42%. DJ Shanghai up 0.06%. Hang Seng up 2.59%. And the Taiwan weighted when it last closed on the 11th was up 1.6%. All right, so good stuff there. Let me close that window. And we'll bring up our chart, and we'll look and see how the markets have done over the last week. Starting out with the Dow, it looks like it's going to finish the week up about 1.64%. The S&P 500, 0.78%. It was up. NASDAQ, pretty flat, only up about 0.13. The Dow Transports up 1.5, and the Dow Utilities, where's the line? There it is. Up 4.09%. So kind of a backwards week this week with the markets, where the last few weeks we've had the tech heavy NASDAQ and the S&P 500 have been just gangbusters all year, and the Dow's been kind of floundering, and it's been kind of now it's kind of the opposite. I think we're seeing a shift away from technology and growth, the growth sector, and seeing maybe a sector change over to maybe your blue chips, and and from there. So anyways, all right, so that is that. Let me get that off the screen. Let's get into the economic data that came out this week, starting out with initial jobless claims. Came in at 222,000. Forecast was 236. Previous number was 239. Continuing claims came in at 1.852 million. Forecast was 1.86. And the previous number was 1.856. Consumer Price Index grew at 3%. Forecast was 3.1. So a little better than forecast, and the previous number was 3.3%. Month over month, we showed a 0.1% contraction. The forecast was 0.1% growth, and last month's number was 0. Producer prices year over year grew at 2.6%. Forecast was 2.3%. And the previous number was 2.4. And on a month over month, grew by 0.2%. Forecast was 0.1. Last month's number was flat. The Michigan Consumer Sentiment Index came in at 66. Forecast was 68.5, and the previous number was 68.2. All right, so that was all the data this week. So good stuff there. All right, let's get into the market recap for today. Dow closes just shy of record as earnings season gets underway. All right. The Dow closed just shy of a record despite reaching an all-time high on Friday, buoyed by better than expected earnings from several major Wall Street banks and a modest rise in wholesale inflation. JP Morgan Chase, Citi, and Wells Fargo kicked off the second quarter earnings season. JP Morgan Chase reported results that exceeded Wall Street estimates, though its net interest income and loan loss provisions were less impressive. Wells Fargo cut its outlook for net interest income, causing a 5% drop in its shares, while Citigroup saw a nearly 1% decline after reporting its earnings. Investors anticipate robust profit growth from a diverse range of companies, potentially extending the rally in U.S. stocks beyond the tech sector. Bernstein analysts noted that if analyst predictions hold, this quarter could see the highest year-over-year earnings per share growth since Q4 of 21. The tech-heavy NASDAQ experienced a nearly 2% decline on Thursday as investors' interest shifted from large-cap stocks to smaller companies amid rising expectations of a Federal Reserve rate cut in September. The probability of a rate cut in September has increased 86%, up from 72 a week ago. The Producer Price Index, measuring average changes in selling prices received by domestic producers, rose 0.2% in June, above the 0.1% expected by economists, bringing the annual figure to 2.6%. Core PCE, excluding food and energy, rose 0.4% in June and 3% year over year, surpassing economists' estimates of 0.2 and 2.5% gains, respectively. Morgan Stanley estimates suggest these figures would lift core PCE to 0.205% in June and from 0.08 in May and to 2.57 for the year through June. That's a lot of percentages. Despite the faster pace of inflation, consumer expectations for inflation a year from now fell to 2.9% from 3%, according to the University of Michigan. Tesla jumped 3% despite UBS downgrading the stock from neutral to sell due to valuation concerns and potential delays in growth opportunities like AI. And lastly, Carvana also surged to a 52-week high. All right, so that's everything going on in the markets today. Let's go ahead and dive a little deeper into the June producer price indexes and see what was in there. Producer prices saw a resurgence in June after a temporary slowdown in May, diverging from the consumer price index trends observed recently. In June, producer prices increased by 0.2%, marking a 2.6% rise over the past year, the highest 12-month reading since early 2023. The pace of producer price inflation has been accelerating since the beginning of the year, now up at a 3.2% annualized rate over the past 6 months. Despite the 2.6% decline in energy prices and a 0.3% drop in food prices, core prices, which exclude these volatile components, surged by over the past year. This represents the highest 12-month increase in more than a year and signifies a shift from moderation in producer price inflation seen in 2022 and 2023. The year-over-year comparisons have been climbing each month of this year, potentially influencing the Federal Reserve's decision making regarding rate cuts. The details of the June report reveal that services prices primarily drove the index higher, with a 0.6% rise in June and a 3.5% increase over the past year. The June surge was largely due to a 1.9% jump in margins received by wholesalers. Excuse me, tired. Conversely, goods prices declined in June, mainly due to a drop in energy and food prices. Inflation trends moving forward are likely to be heavily influenced by the services sector, which has become a focal point in consumer demand after the COVID-19 shutdowns. Further up the supply chain, prices in June fell by 0.2% for immediate demand processed goods, but increased by 1.4% for unprocessed goods. There is an expectation that inflation will ease if the Federal Reserve remains patient and allows tighter monetary policy to take effect, alongside the delayed impact of the M2 money supply reduction. Well, it's actually growing this year. However, there is a risk of inflation reaccelerating if the Fed eases policy too quickly in response to signs of economic trouble. Well, they're just itching to lower rates. I mean, that's really been the story over the last year and a half, almost 2 years, really since they started raising rates. Those in the financial journalism field have been just begging and pleading, hey, please lower rates. It's killing us to have to pay interest on loans. I know, it's crazy. All right, one last article here. This comes from Zero Hedge. Biden's student plan, loan plan save will cost $230 billion. Isn't that excellent news? I mean, these lazy college kids, why should I have to pay for their loans, especially since I never borrowed any money to go to college? I mean, granted, I only have 35 hours of college credits to my name. By the time I got into this business, I was like, why should I go back to school? It's a giant waste of time. You got to learn this stuff on your own anyways. So, I basically have been educating myself since then. All right, let's get into this last article here. This comes via shiftgold.com. The U.S. Student loan debt has ballooned to $1.7 trillion, prompting President Joe Brandon to propose the SAVE plan, which the Congressional Budget Office, the CBO, reports estimates could cost $230 billion. Awesome. This plan, in an attempt to address the Supreme Court's ruling against Biden's initial student loan forgiveness program, could exacerbate inflation, increase college costs, and grant the federal government unprecedented control over higher education. I mean, what's fun, and I try to stay out of the left, right, who's good and who's bad as president. However, Joe will say with a straight, well, Joe doesn't know what he's saying, quite honestly, but Joe will read off the teleprompter that Trump has a fire hose of lies, blah blah blah. But then he'll come back and the Supreme Court will say, no, you can't do that, and then they'll just try and work another way around the law to do something, even when it's illegal, which is hilarious. And then secondly, in that first debate they had, Joe said that he hasn't lost a service member on his watch. I mean, seriously, there's been no service members that have died since he assumed office in January of 21. Really? Afghanistan? Seriously? I think 13 people died in that catastrophe. Anyways, let me get back into it. Historically, federal student loans operated on a straightforward installment plan. However, reforms like the 1993 Student Loan Reform Act and the subsequent policies have introduced income contingent repayment plans, reducing monthly payments based on borrowers' income and forgiving remaining debt after 25 years. These changes have made the system more lenient, but also increased the federal government's role in student loan management. The SAVE plan continues this trend, offering significant reductions in discretionary income calculations and lowering payment percentages to as little as 5%. Well, if I could break in here again, there's also plans out there where, if you go and work for, the federal or state governments, they'll just wipe out your student loans. It's nuts. I mean, seriously, you borrow the money, pay it back. It just, it pisses me off. This makes it easier for borrowers to qualify for reduced payments and eventual debt forgiveness. Moreover, recent policies have seen the Department of Education forgive billions in debts under various pretexts, further complicating complicating the financial outlook. The SAVE plan faces legal challenges from attorney generals in 3 states who argue it oversteps executive authority. Despite these challenges, without an injunction or congressional intervention, the plan is set to be implemented in July of 24. Courts in Kansas and Missouri have already blocked further enrollment in the SAVE program. The plan's estimated cost is speculative due to the variable of income-dependent repayments and potential future changes. The ultimate expenses could be substantial given the trend of increasing reliance on income-driven repayment plans. The SAVE plan fits into a broader federal objective of increasing control over public higher education. Critics argue this manipulation could target specific demographics or employment sectors, reinforcing political agendas. The plan's opponents call for more responsible measures to address student debt and protect taxpayers from bearing the brunt of these expansive forgiveness programs. Now, I would not have a problem if the federal government wanted to seize the assets of the educational institutions. If you want to go into the endowments of UT, University of Texas at Austin, Harvard, Yale, they've got billions of dollars sitting in their endowments. Now, if you want to go rob them, and then after you've robbed the financial institution, who benefited from these loans? Because I didn't benefit from the loans. These students didn't pay me with the money that they borrowed. They paid the education or the universities to, for their education that they got. Obviously, it was so good that the return on investment has not allowed them to pay off their debts. So anyway, like I said, they want to steal from the finance, from the colleges, feel free. Rob them blind. I don't care. College is just another form of government, in my opinion. So, anyways. All right. Well, that's everything I had for today. You've listened to me bitch on my soapbox long enough. So if anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. If you need to get your financial crap together so that so that you are able to pay off your loans and not be a burden to your neighbor, give me a call or shoot me an email. I'll be happy to help you get your finances back on track. All right. Well, like I said, that's everything that I had for today. And hope everyone has a fantastical weekend. Hope you don't burn up over the course of the next few days here in the Southwest. And hopefully my friends down in Texas, or most of them got their power back on, hopefully. And, because it's humid. I mean, hot here and hot in Houston are like two different things. I mean, I'll take 100 or 110 out here in the Southwest any day. Las Vegas, San Antonio, anywhere where there's no humidity, it's not that terrible. I mean, it's hot. I mean, I don't want to, minimize it. It's warm. However, Gulf Coast hot, 95, 100 degrees with, 100% humidity. Whew, that will, trust me, I grew up there. I played sports, in the 80s and early 90s as a, young person. And, it makes you tough. I mean, if you can survive playing football and, doing 2-a-days in August in Houston, you can pretty much survive anything. Anyways. All right. Well, like I said, hope everyone has a fantastic weekend, and I'll talk to you all next time. Adios.